You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Steve Clapham, the founder of Behind the Balance Sheet. He's also the author of an awesome book on investing called The Smart Money Method. So thank you so much for being on the podcast, Steve. It's awesome to have you here.
Oh, well, thank you so much for having me. I'm very excited. I've never done a podcast with somebody as young and as smart and as enthusiastic. So I'm really looking forward to it. I'm sure we'll have fun.
Absolutely. So, Steve, could you tell the audience a little bit about your background? You know, you've got an awesome background. You know, you've worked with Tiger Cubs and you've done all sorts of crazy things. So, you know, for someone who might not know who you are, could you just tell them a little bit about your background, your journey on Wall Street, and, you know, I guess your journey in London, because you're based in the UK. So
I live in London. I'm actually Scottish, which has been a cause of great consternation because we're in the middle of the Euros as we're recording this. For those of you in North America, the Euros is a very important soccer championship.
Yep.
And Scotland have got to the finals for the first time in 23 years, I think. Anyway, my story is that I was a sell-side analyst for many years. I covered various sectors, actually various geographies. I was one of the few sell-side analysts in Europe to follow US stocks as well as European stocks. But I did that for 15 odd years. And then one of my clients asked me to go and join them. I worked for a small firm and I just did really focused research and trying to find winning stocks. And I had a very small group of clients, but they were amongst the most successful hedge funds in London and in the US. And one of them asked me to go and join them. And this was a financials fund. And they were doing more in the non-financial space. And they asked me to come and help them because they had a group of financial analysts, but they didn't have anybody to do the other stuff. And I was kind of like a special situations analyst, really. And it's a very good training ground because you do special situations, you're looking for the most attractive risk reward opportunities in the world. So it was a global fund.
Yep.
And it was quite exciting because I'd never really done anything much in emerging markets. I'd looked at the odd thing, but you know, you're in the sell side, you've got a very narrow remit generally. And so when you start to look at stocks in emerging markets, it's really just as a reference point to look at comps. And so this was a real eye opener for me. And so I was a partner at a Tiger Cub. I was head of research at another multi-billion-dollar fund. I then went off, set up my own business. I ended up helping a wealth manager in London. And they were very good in the UK, but they didn't have anybody with experience of international equities, and they were wanting to do more internationally. So they said, "Can you pick some international equities for us?" Which that was quite interesting. And then they said, "Can you manage some of the portfolios for some of the more aggressive, higher wealth clients?" And so I started to manage some money for some of them, but I was quite divorced from the stock market. You know, it wasn't, you know, wealth manager. They had very limited amount of brokerage accounts. They had very limited amount of research available to them, and it was really difficult. You know, people tend to think, oh well, wealth management, it's not as difficult as institutional fund management. But the thing that I found really hard was I was doing very well. And so I would then get a new client would want to you know, me to run their money. And of course, when somebody comes to you afresh, you've got to start afresh. And so, if somebody comes and adds money to the fund, you can just top up what you want. But if you're doing something from scratch for somebody, you've got to start from scratch.
Right.
And so I had the opportunity to go and work for another hedge fund. It was a small fund and they were just trying to grow it. And so I did that for a while, but it wasn't very successful. And I didn't enjoy it as much as I'd hoped. And ended up, we weren't doing that well. And we decided to close the business. And I thought, well, no problem. I'll just go and get another job. I'll get a job as an analyst at another fund. I applied for 47 jobs. It doesn't sound that much, doesn't sound that many, but I'll tell you what, it is a lot of time, filling out all those forms. And it was all online. And I didn't get a single interview. In fact, the only person that replied to me was a fund where a friend of mine used to have them as a client. He was a broker. One of my brokers used to broker to them. I said, oh, can you call them up and tell them that they should employ me? And they were the only people that responded. And they only responded to say, oh, I'm sorry, you've not got an interview. So I decided that, my age was counting against me and I needed to do something where my age would count for me. Right. So I set up a training business, and that was behind the balance sheet. I started off doing training entirely for institutional investors. I mainly did one-to-one training. And then I was asked to produce a forensic accounting course. And that forensic accounting course has been incredibly popular because in the UK, this was May of 2018, and the UK saw a whole string of collapses, 2017, 2018. And people said, man, that could have been me. Or they said, that was me. How do we stop that happening again? And so that was, the forensic accounting course is very popular. And you won't be aware of a company called Patisserie Valerie, which was a small cap UK cafe chain, which went bust. And I had said, it was making margins that were just ludicrous. They were just stupid. And so I then started being asked to speak at private investor conferences. And that led me to set up an online training school. So if you go to my website, behindthebalancesheet.com, you can enroll in various investing courses, which are quite unlike anything else that you can do. And, there's a lot of people who have read a lot of investing books, and there's no question you can read. There are some brilliant investing books around, and you can learn a lot from them. I think, people have kindly said that they can learn a lot from my book, but the difference between reading a book and doing a course is immense. And it seems bizarre that this is an area in which, so many people have got so much interest and so much money at stake that they're poorly served. And so I'm just trying to remedy that. Got it.
And so what exactly do you offer, as part of your training service? So is it just primarily, focused on just forensic accounting? Do you teach people how to, read balance sheets and invest, or how does it work?
Well, on the institutional side, my main product is my forensic accounting course.
Right.
And that's been incredibly popular. Hundreds of analysts, portfolio managers, even CIOs have been on that course, and they all go, oh man, there's a lot of stuff that we should be on the lookout for. And, I've been doing this for a long time, Sri, and, it's the Malcolm Gladwell, the 10,000 hours operates. When I pick up a company and, look at the balance sheet, I've done it so many times, I can usually quickly go to the area where there's a problem. And what I've tried to do in that course is to give people the tools without having to spend the 10,000 hours. So I've spent the 10,000 hours and I try and teach them the things that I've learned to look for. But in the online content, it's mainly target. I've got quite a few institutional clients in the online school, but it's mainly targeted for the private investor and teaching them all aspects of investing. So we've got a course called the Analyst Academy, which teaches you how to become a proficient investor. And we've got a course called the Analyst Academy Pro, which is launching in the end of June. So we're recording this just in the middle of June. So end of June, early July, we're doing a 6-month program for graduates who are trying to get a job in asset management. So we take the basics of the Analyst Academy. And Analyst Academy, what we do is we teach you how to read a set of accounts. So how to take the financial statements in the 10K and analyze them thoroughly.
Yep.
We then go through the program that we outline in my book of how to pick winning stocks. So how to find a good idea, how to research it, make sure it's a good idea, how to research the industry, how to research the company. We then go through a module which is how to value companies. So we go through, we explain why, everybody talks about the capital asset pricing model. And if you go to university and do any sort of economics or finance course, they'll tell you about the capital asset pricing model. And it's ludicrous because it's a complete waste of time and energy. I almost don't understand why they teach it. I do understand. So we go through the capital asset pricing model and why it's a stupid way of looking at companies and what you need to do in practice. And we then have a module which is about how do you decide when to pull the trigger and in what size, and how does a stock fit in a portfolio? And then once you've got a portfolio, what do you do? How do you monitor it? How do you know when to sell?
Yep.
And with the pro part of this, we're also teaching students how to write a research note, how to do a stock pitch, how to build a model, how to do a profit forecast. So the profit forecasting one is quite interesting because I'm been busy doing that at the moment. And I stupidly picked Carnival as my stock because I thought it will appeal to people in the UK and it will appeal to people in the United States because it's got dual listing.
Yep.
But I hadn't actually thought how complicated it is. So it's taken me twice as long if I'd taken a very simple, if I'd taken a Facebook or something, I could have done it in half the time. But I think that's quite good because people can follow my travails and see, okay, so how did he do all this, and can see how difficult it is. And I think I'm on module 15 and I've only just got to the profit before tax. I haven't done any of the cash flow. I haven't done any of the balance sheet. It took me several modules to look at revenue. It's taken me several modules to look at interest. I'm not finished on interest. But because it's such a complicated situation, especially right now, I think it's really good because you couldn't find a more difficult example. And I think, if you're going to spend the time, the energy and the money learning about this, you may as well learn, how to do it properly.
Yep. Yeah. Got it. Well, how to jump into, the interview and talk about, actual accounting questions and so on. So, what sort of, balance sheet activities and, accounting, tricks and so on are you seeing in the US and Europe at the moment?
Well, there are so many. I don't know where to start. The past 5 years has been, in my experience, an unprecedented time because I've seen more tricks being employed than I have at any other time in my career.
Mm-hmm.
So when I was doing the forensic accounting course, when I was building it, for reasons completely unconnected, I was going around various small cap analyst meetings. And I wasn't going there because of the forensic accounting course. I was going there for a completely separate reason. Every single meeting I went to, I found an example I could use in my course. There was not a meeting I went to that I didn't go, man, that is just ridiculous, the things that these people are up to.
Mm-hmm.
And there was one company that I went to, which is a company called Stobart Trucking. And they're a logistics company. So they run trucks and operate warehouses predominantly for retailers, a few manufacturers, and they're a third-party logistics firm. You have them in the US, companies like XPO.
Mm-hmm.
And I went to this meeting, and I mean there were various things that the company was doing, but they produced a set of adjusted earnings, and they added back £445,000 for the weather. And I said to the finance director afterwards, I said, so just run me through why 445,000, why not 450 or 500? And he said, oh, well, that's because the A38 was closed for 3 days and 5 days, and we had we have a big warehouse there. And I just walked out of that and I just thought, man, you're on a different planet. You know, this is a finance director. I mean, there was no way that he could possibly estimate the impact of snow on the business to the nearest £5,000. He also added back startup costs on new contracts to get from the GAAP earnings to the adjusted earnings that analysts are all using. And startup costs, I mean, they're part of the business of doing logistics, because each time you win a new contract, you've got to, you've got to set up a new warehouse. You've got to employ people. You've got to train them. You can't do it without startup costs. It's part of the business. And they'd never adjusted for startup costs before. Right. Previously, they'd always taken startup costs in the chin. But without those two adjustments, the earnings would have gone negative, not positive.
Mm-hmm.
And it's like, this is just, it's just so obvious, so basic that, but people get fooled by this sort of thing. And as I say, I couldn't tell you how many meetings I went to, but 15 probably, and every single one gave me an example. And all sorts of things, not just messing around with the adjusted earnings or the adjusted EBITDA. There was a whole string of errors. And the issue, and it's particularly prevalent in the UK and Europe, it's not quite as extreme in the US, but it's still a problem in the US. What we've had here is we've had the introduction of MiFID II, which has restricted the ability of people to pay for research. So for fund managers to pay for research, because now most fund managers, or the majority of fund managers, are paying for research out of their own pocket. Previously, the cost of research was just passed on to the end investor, and it was just, it wasn't a big thing. So everybody bought as much research as they felt they needed. Mm-hmm. Now the research is being paid for out of the company's own P&L in most cases.
Yep.
Certainly in many cases. And obviously people are a lot more sensitive to it. So as a consequence of that, there's a dumbing down process going on in the sell side. And that dumbing down process isn't exclusive to the UK. It's a process that's been going on globally for many, many years. Analysts today follow many more companies than they did 20 years ago. And what we're seeing now is that the sell side is much less experienced, much younger, much less experienced, and much less knowledgeable about the accounting tricks. And at the same time, the accounting's become more complicated because the rules have become more complicated, and the finance directors have become better at using all sorts of tricks to flatter their numbers. So, you've got a cocktail here, which is just explosively bad. I mean, it's really a very dangerous situation. And interestingly, just today in one of the Sunday papers in the UK, the business editor was lamenting the fact, MiFID II has been a disaster for us. And this is creeping into the US because big international fund managers who are US domiciled, they're having to do this in Europe. They're thinking about, well, maybe we need to do this at home as well. So, yeah, I mean, the the price people are prepared to pay for research has gone down.
Mm-hmm.
And I mean, in some ways, I think that's a good thing and perfectly understandable.
Yep.
Because obviously the research in many cases is rubbish. Right? You get what you pay for. But I think it's a massive issue.
Got it. And one of the things you mentioned was sort of the delta between the GAAP numbers and the adjusted numbers that come out of a company. So what other tricks are being used in order to make the adjusted numbers look a lot better? Could you go more into that?
Well, I mean, people will use all sorts of tricks, right? So I gave you the one about the weather, gave you the one about the startup costs. I mean, these are very typical. You add back things that shouldn't be added back. I mean, the most popular one today, and it's so popular, it's sort of almost accepted, is stock-based comp.
Mm-hmm.
So I can't think of any company that I've looked at where they've taken the stock-based comp charge as a hit to adjusted earnings. And the problem with stock-based comp is not only does it not hit your adjusted EPS, it doesn't hit your cash flow.
Yep.
It's not a cash item. So it's like a miraculous disappearing expense. And very few people understand how to handle this.
Mm-hmm.
I mean, I had one of my good clients who are very sophisticated, very thoughtful people. They've got $50 billion under management, which isn't a lot if you're based in Boston or New York. But I can tell you, it's a lot if you're based in Edinburgh, or Dublin, or London. And they would say, said to me, well, how should we think about this? And there's a piece of research done by a pal of mine in Twitter who looks at SaaS companies. And he said the stock-based comp charge has gone from 8% to 24% of revenues for the group that he looks at. And the funny thing about that is that the stock-based comp, the charge, according, the GAAP charge, isn't a real reflection of the true cost. So, I mean, I think the accounting standards are really poor in this respect. In fact, a number of the new accounting standards are really, really bad. The new one on leasing is a complete nightmare. I mean, it is awful. And but if you're, if people aren't even using it, well, I don't know what people do.
Could you explain, what as you mentioned, the one on leasing? So number one, could you explain what the new standard is, and number two, why you think it's garbage?
Well, the leasing standard attempts to take operating lease rentals. Mm-hmm. So, give you a typical example would be an airline renting an aircraft.
Mm-hmm.
So you've got two retailers. There's, one's got the shop at number 24 and one's got the shop at number 22. They sell exactly the same things, exactly the same prices, make exactly the same profit, except that one owns the freehold and one has a lease.
Mm-hmm.
Now, what the standard tries to do, and the standards are slightly different in the US and in Europe. The one in the US is actually intellectually less rigorous, but in practice better. The one in Europe is just, I think, really quite poor. But what the idea behind the standard
mm-hmm. is
that the two companies should have the same set of accounts. So the one that's got the property on its one's got property on the balance sheet, the other one's got a lease rental. So they put the property on the balance sheet as a notional asset. But of course, you can imagine that there's a huge amount of difficulty in ascertaining what is that asset really worth. And what they've done is they've compromised. Instead of actually trying to get what the asset is really worth, they've tried to capitalize the right liability in the balance sheet. And those two things are very different. So you might have a 5-year lease and the corresponding asset is quite low.
Mm-hmm.
Or you might have a 20-year lease, in which case the corresponding asset and liability are higher. But the guy who's got the freehold next door there's no change, right? Now, obviously, these are things that, in practice you cannot get around. But the problem with the way that they've done it is that all the financial statements are completely affected. So you've got these notional assets in the balance sheet, which aren't assets at all. You've got these notional liabilities in the balance sheet, which you could argue, well, there is a liability, because if you've got a commitment to pay rent for the next 5 years, that is a real financial liability. But the numbers just don't make sense. And two companies can have very different approaches to the way they capitalize their lease rentals and come up with very different results.
Yep.
So the comparability of accounts is fundamentally undermined. Now, I used to do the transport sector, and the transport sector are massive users of operating leases, because every airline uses operating leases, not necessarily because they're trying to take things off their balance sheet, but simply in order to give them some operational flexibility.
Yep.
Because when you have a COVID experience, you can give some planes back.
Mm-hmm.
And, obviously when you've got a recession, you can give some planes back.
Right.
So, there's a very good reason why you would want to have operating leases. But you end up with a really odd result in many cases. And I don't think it's that helpful.
Got it. And overall, what sectors of the economy, concern you the most, especially when it comes to using accounting standards to play around?
Well, in the case of the leasing standard, it affects retailers, transportation companies more than it affects most companies. But it's affecting quite a lot of companies. In the case of financial shenanigans, where companies are cheating and we have to look for accounting red flags, sadly, I'm afraid that it is every single company, every single sector that you can see. There's not there isn't a sector that is immune, or if there is, I haven't found it.
It was funny, you start off with talking about airlines and transport. Do you have any thoughts on EVs and SPACs and that sort of thing, where you see companies trading at crazy valuations? Do you have any thoughts on pretty much that?
I think it's nonsense, to be honest. I mean, I've had a very interesting conversation with some venture capitalists, and the venture capitalists think this is fantastic because, of course, it means that they can get out of lots of their investments, and they can get out of them quicker and at a higher price than they otherwise would. But in theory, the idea that you can give a profit forecast, you would think would be a good thing.
Mm-hmm.
But if that profit forecast is just something that I could just knock up on the back of an Excel spreadsheet in an afternoon, and it's just my aspiration, you're giving a hell of a misleading signal to the capital markets. And I think that's a very dangerous precedent myself, because how do you know that those profit forecasts are achievable? And people are investing on the back of these forecasts, and the people that are investing generally aren't the people that are the most sophisticated. It's no problem for somebody like me. I can take the forecast and look at it and go through it and say, well, that's nonsense and that's not achievable. That sounds sensible. I can do that work. But the vast majority of people that are being asked or that are investing in these things don't have that ability. And so I think it's really quite dangerous in my view. And there well, obviously, as we speak, loads of the SPACs are underwater.
Yep.
But I just think it's an incredibly incredibly dangerous trend, and one which the authorities, I think, should be doing more to police. On the EVs, I mean, I just don't get it. The automotive industry has always been a very difficult place to invest because the automotive industry it's overly competitive. It's too much capacity globally, and so it's actually very difficult to make money. And the EV brings a whole different dimension to that. Now, there is an assumption that the new disruptors will be the ultimate success stories. And I think that's highly unlikely because it's very difficult to make a car, right? It might be even more difficult or less difficult to make an electric vehicle. Clearly, the incumbents have got less experience of making electric vehicles. But I'd be incredibly surprised if they aren't making electric vehicles more efficiently and more cost effectively than some of the incumbents. And some of the valuations, the Nikola truck, Lordstown, they just don't make any sense.
Yep.
There's just, in my view, no way that I can rationalize those valuations. In order for some of those companies to be worth what they were trading at, particularly at the peaks, you'd have to assume that they were, producing, very large numbers of cars. And I was quite amused when I read one of the Bailey Gifford articles saying that, they were looking forward to Tesla making millions of vehicles. I was thinking, you can't argue. Tesla has done an amazing job, absolutely fantastic job. And they've, come from nowhere to being a very serious contender. But, millions of cars, you've got to assume that, that they've got, that they build and consolidate a share and of that market. And we're a long way from that, much, much easier to grab market share when you don't have any competition. But if you speak to people in the automotive industry, they don't see Tesla as being particularly difficult competitors. They think that they're, if you spoke to Audi before they launched the first electric SUV, which they launched in California, they were laughing. You look at the panel gap on a Model 3, they think it's hilarious.
Got it. You mentioned Lordstown. I believe it was Lordstown last week. They announced that their so-called binding orders were, were never actually binding orders. And the CEO and the CFO quit on the news, which was, pretty interesting to watch. And, overall, do you think Tesla's accounting is kind of shaky? Because there's a whole group of investors on Twitter who put themselves as part of the Tesla Q crowd, the TSLAQ, implying that Tesla is headed towards bankruptcy. Do you have any views on the accounting that Tesla does, or its financial statements?
Well, Tesla financial statements are I wouldn't say they're exactly a work of fiction, but they're certainly not accounting statements as I would recognize them. They're using a lot of tricks to make their performance and their financial position look a lot better than it is. Some of those are legitimate, right? When you buy a Tesla, you have to pay for it, I think, a week or 2 weeks in advance. Normally, when you buy a new car, you make a payment the same day. They require, I'm not sure exactly how long it is. I think it's at least a week. So they've got a week of sales in cash, which isn't their cash. Now, that is one of the more legitimate tools that they've used. to make their financial performance look as good as it could be. But nobody talks about issues like that, and if you look in detail at the Tesla financial statements, there's so many tricks that they're using. One of the things they do is they redefine EBITDA on a quarterly basis almost, so that when whatever you're looking at isn't what you looked at the previous quarter. Yep. So those are not strategies that are employed by well-run conservative companies. Those are strategies that are employed by people that are trying to deceive.
Got it. You've worked with Tiger Cubs, you've done all sorts of amazing things. So, what does your research process look like? How do you go through these financial statements to come up with, whether or not what you're investing in is actually financially sound or not? What techniques do you use or do you teach, to your students to actually identify accounting problems?
Well, there's two parts to the process. There's one part is the financial statements, the other part is the business. So, those are two different things. And, I have
Let's go
obviously, got people have sort of looked at me as being, one of the sort of accounting experts. I wouldn't really necessarily consider myself particularly an accounting expert. Obviously I've been doing it for quite some time, and I'm an accountant, and I've been talking about accounting red flags, but to me that's kind of like what you need to do just to get started. If you can't read the balance sheet, you shouldn't be in the game. I know there are plenty of people that invest without having the first understanding of financials, but if you're going to be a professional investor, you've got a responsibility, you've got fiduciary responsibility to your end investors. And that means you've got to check the financial statements. It is a given, it's a prerequisite. But the tools that I use are fairly simple. There's nothing sort of particularly fancy about it. One of the tools is working capital ratios, and we look closely at the trend in working capital. One of the tools that we use is the comparison of earnings and cash. So, if a company is earning money, it should be generating cash. And if it's not, there's usually something wrong. And then there's a whole suite of things that we look at. I've got a YouTube channel. So on the YouTube channel, we've got a whole section on accounting red flags, and I've got to record a couple more next week, and we'll be recording ones on directors. And you look at the board, who's on the board, and are they there to help you and protect your interests? And one of the things that you often see is, you saw it with Theranos, the big fraud a couple of years ago, where they filled the board with the great and the good, we call it. You see it here with Greensill, where they had the former Prime Minister, David Cameron, as an advisor. But, Theranos had James Mattis on the board, George Shultz. Two secretaries of state, both in their 90s. And you think, well, there were a couple of doctors, but you think, well, what possible value could two former Secretary of State have to a biotech, healthcare, high-tech startup? You look at that and you think, well, why? Why are they lending their names to it? And why does the company feel the need to have those people? And, those sorts of signals are signals that, your antenna should be up. And when your antenna are up, then you start to think, okay, there's some warning signals here. Maybe I should look at some other issues. We had the same thing. I did a thing on Greensill, which is a big fraud here, which is gone bust, and where Credit Suisse have got $10 billion of funds which are associated with it. And it looks like the end investors are going to lose $2+ billion, which I suspect that, Credit Suisse may end up having to foot part of that bill. But when you look at the Greensill accounts, I've forgotten how many, 6 or 7 directors resigned in a single day. Now, there might be a plausible reason, I'm not saying that necessarily means it's a fraud, but it necessarily means that you think, well, there's something quite unusual about that. Another director had joined the board and resigned a month later. Now, that to me is a very, very bad signal, because why would you join the board and then resign? The most likely explanation is that you've seen something you don't like and you don't want to be associated with. Yep. Now, I don't know if that was the case with Greensill, but when I see that sort of thing, I think, oh, okay, I need to look even more closely at this company because it's got some, it's in the risk area. And in the forensic accounting course I do for institutional investors, we go through a whole module, a really long module about all the signs to watch for. And there's lots of them, because every fraud is different. We go through, some signals that we think are very successful indicators of companies where they're cheating. And some of that's language.
Could you give us some more examples of, some of those forensic accounting signals or red flags that, I guess you teach to your institutional clients?
Well, I kind of prefer them to come to me and pay me to get the signals. I mean, there are lots of signals given off. The language, which is very, very complicated language, is usually a very bad sign. A company that's trying to overcomplicate something. Mm-hmm. If you read Warren Buffett's letters, they're incredibly simple, incredibly clear. A 15-year-old child could read them and understand them, or a 12-year-old kid could read and understand them. Maybe not understand everything, but they would get a good sense. That is what company management should aim for. They should aim for a crystal clear communication. This is what we're doing. This is why we're doing it, and this is what you should look for. Mm-hmm. And companies which have clouds of smoke and incredible complexity are companies that you should be more worried about, because that's not, if it's incredibly complicated, you have to ask yourself, well, why? Because Berkshire Hathaway is not a simple company, but you can explain it very simply.
And then, are there any places where you don't see these tricks being played? I'm guessing Berkshire would come under that category. But now, are there any companies or are there any industries or sectors that you see, where there are a lot fewer accounting tricks compared, I guess, to the average?
Yeah, well, there are some good companies, even in the United States, even in the tech sector. Microsoft is a very clean, company with a very clean set of accounts, mm-hmm. but there aren't many.
Yep.
And when you look at Microsoft, you can say the accounts are quite clean, but they've got a very, very low tax rate, which that's the one thing on the Microsoft accounts. I haven't looked at Microsoft for some time, but when I have looked at it, it's looked pretty good. I haven't done a detailed examination of it, to be fair, so I shouldn't hold it out as a paragon of virtue without having done the detailed analysis. But the one thing with Microsoft is got a very low tax rate, and I don't like companies with very low tax rates. A, because it makes me wonder if their profits are real, and B, because I don't think low tax rates will endure in the present environment. And we've been seeing with the G7 recently that there's very strong moves to bring companies to bear and make them pay more tax. But there are very, very few companies that I look at that I go, oh, that's a nice set of accounts. There are some, but not that many.
Got it. And going to the other side of the spectrum, what is the biggest false positive that people see in financial statements? So what is something that people look at and they think it's indicative of fraud, but it's actually pretty normal?
Well, funnily enough, the working capital ratios often give misleading signals. Mm-hmm. So, a company that's growing fast will often create large working capital balances that make it look like the sales are being exaggerated or whatever. And high growth companies tend to throw off false positives.
Mm-hmm.
So if you look back, and the reason I say Microsoft's quite clean is when I apply various tests, Microsoft always comes through, but you'll get a company like Amazon will the odd year give a false signal that there's something wrong.
Okay, got it. And what does your valuation process look like? Do you go look at multiples? Do you run, DCF valuations? How do you go thinking about that?
Well, I mean, to be honest, valuation is not a big part of my process.
Mm-hmm.
So, obviously you need to value the company because you need to have comfort that it's cheap. But a lot of people will arrive at a stock because, the sell side say it's on a P of 18 and it should be on a P of 21. And I find that to be a singularly unsuccessful, not very fruitful source of ideas. Because generally speaking, stock market can see that the comps are on 20 times and this one's on 18. And there's a reason why the stock market has put that discount in place. Mm-hmm. And yeah, I mean, obviously that discount can reduce and it can become a premium. The stock market can change its mind. But what I've found more often than not is that the stock market has well understood that the valuation gap and has decided that for whatever reason, this company's not as good as its peers. And, what my process is focused on is looking for changes in a company's disposition, changes in profitability, for example. The most money to be made is where you find a company where the stock market thinks it's going to make $100 million and it's on a P of 20 and it's got a capitalization of 2 billion. And you've got a good reason to think it's going to make 120. And generally when that happens, you don't just get a 20% uplift, but you also get, it'll go from 20 times to 21 times. So you'll get not just the 20% uplift because it's beaten earnings estimates by 20%, but you'll get a further 5% appreciation or a 10% appreciation in the multiple. So my process is much more focused on using the forecast profitability rather than looking at the valuation multiple. Having said that, I mean, I do spend a considerable amount of time trying to understand what the valuation multiple is and what it could be in the future based on my perception of that company's profitability. And the converse is true for shorts. Often you'll go short something because you think the consensus estimates are too high. And if a company doesn't make its earnings, it usually goes down, right? But in terms of evaluation tools, I mean, I just did a video this week on the YouTube channel where I talked about EV to sales. And, EV to sales is a more popular multiple today than it ever used to be.
So EV as an enterprise value, right?
Yeah.
Okay.
Enterprise value to sales. And the reason that I like that multiple is, every finance director I've met has got a tendency to push the earnings as fast as they can. But it's much harder to manipulate the sales. I mean, obviously you can bring sales forward. You can, if you're a fraud, you can make them up, right? So, they're not sacrosanct. But the sales are much easier for the auditor to audit, and they're much less likely to be wrong than the earnings number or the EBITDA number.
Yep.
So using sales is a more reliable data point. And I found that EV to sales, if you've got something that's very cheap in EV to sales or very expensive in EV to sales, the earnings number might look fine.
Yep.
But the EV sales gives you a different signal. And everybody's looking at the EV, everybody's looking at the PE or the EV EBITDA. So you need to look at something different. And I found EV to sales to be a really useful indicator of a stock which is long-term cheap because its earnings are temporarily depressed.
Got it. I wanted to move to sort of your views on the market today. So, do you personally think that overall, equities remain overvalued, and where do you personally see opportunity, especially on the long side today?
Well, I'm not sure that they're overvalued. If interest rates are zero forever, then, stocks are worth a lot, right?
Yep.
But I think, I'm a believer that we're moving, secularly from growth to value. I don't like the terms growth and value because to me, what's a value investor? You can be a value investor and invest in Amazon because it's, it's buying something for less than it's worth.
Yep.
But that those terms are traditionally used to look at two different types of stock, and so I think we are seeing a rotation. I don't think that there's any particular problem with some of the big tech stocks, but I think that, you're more likely to see the opportunity in some of the bombed out value. Having said that, it's hard to find the bombed out value. I've had some stocks have done quite well over the last 12 months. And you think, well, do I really want to be buying more at this point? And, even with the stuff that I own, I struggle to, with the idea of committing more money. It's always more difficult to buy it when it's doubled, right? But it's usually the right thing to do. But I'm shying away from that. There's one stock that I'm still buying that it has doubled. And I think it's still got opportunity, but it's not obviously cheap. And I just think, the markets are really hard right now. There's, stuff that should be bombed out that's gone up a lot. And you think, well, who's buying this? And, I'm looking at stocks and I'm thinking, I can't imagine who is adding to their portfolio in this because it just looks completely the wrong price. But you don't know when those things will turn and when it will be right to short them. There'll be a time to short them, but probably not now because you've got quite a lot of hope about the post-COVID environment, and you don't have a lot of very good indicators as to how things will pan out. So, in a way, it's pointless fighting against the hope unless you've got deep enough pockets and a long enough time horizon. But the shorts, I always tend to try and be cuter on the timing of entry points because it's very painful when a short goes against you.
Yep.
On the long side, I don't have any particularly bright ideas. I've been saying for some time that I thought the casual dining sector in the US was a very good place to look for opportunities. I don't know how it's valued today. I've looked at a couple of things in that area. And I think that there's mileage there because you've got some upward pressure on labor costs because labor is hard to find. You've got some upward pressure on food costs because commodity prices are rising and prices of various food inputs are going up. But you counterbalance that by rents are going to fall almost certainly. There's opportunity on the rent side, rents, reasonable cost. And then you've got the situation where there's a lot of pent up demand. It's obviously, I don't know what the situation is in Canada. It's obviously slightly different in the United States. But, situation in London is that we haven't been allowed to go out and eat. Or we were allowed to go out and eat provided you ate outside in April. Well, it's quite cold here in April. So it's only now that we're allowed to go to a restaurant and eat inside. Right. So restaurants are busy because there's a lot of pent up demand. So that's an area where there's been a big hit to supply. So lots of restaurants and even chains of restaurants have gone out of business, sadly, in the pandemic.
Right.
And that means that the people that are left will have less competition and they should be able to make more money.
Right, absolutely. And how do you think about playing, timing, especially sort of in a market where the narrative is driven by liquidity and the Fed and so on and so forth. Especially, it almost seems like earnings and fundamentals don't matter anymore.
Yeah, I mean, it does seem like that. I know what you mean. At times, it does seem like people aren't paying attention, and certainly, there's been lots of cases, lots of stocks where the market's just gone mad. I think it's much more difficult. I mean, I'm not trying to manage a professional portfolio today. I'm not trying to maximize my monthly returns. So, when I'm in an environment which I don't understand, I tend not to do anything.
Yep.
I mean, I don't even tend to take money out because I think, well, I could take this money out and it could double. And so, if I think something's irrational, my inclination is to, let it run irrationally for a bit longer. And if things start to turn and things start to become rational, I'll take money off the table on the way up, but I won't try and exit until I see that there's strong evidence that there's other people who are bigger, cleverer, smarter than I am exiting, and that that you do get the rolling over, because you can say, oh well, this stock's a stupid price, and it can be twice as stupid. It's very difficult to call. It's very difficult to call the top in an irrational environment, and I don't need to. The only money that I'm running is my own money. Mm-hmm. My family's money, so I don't need to worry about this month's performance. Nobody's asking me.
Got it. Well, to wrap up the podcast, I wanted to ask you: is it possible to actually automate forensic accounting, or is that possible? Have you ever spoken to anyone about it? Have you ever seen anything about it?
Yeah, I mean, I've spoken to several people about it, and in fact, I've given courses to quant outfits who are trying to do just that. Mm-hmm. I think you can automate a certain part of it, but you and obviously with artificial intelligence, you'll be able to get cleverer about it. Mm-hmm. But there's too many variables. So I think that this is an area where there will always be room for the human. I think that investing generally, there'll always be room for the human because it's too complicated. You can't distill it down to a set of variables and press a button. Got it. Even without trying to do forensic accounting, the quant investors find times of rapid change very difficult to handle. The global financial crisis, COVID, very, very difficult for to keep the model running. And when you start getting into things like forensic accounting, apart from anything else, you need a hell of a lot of data. Yep. Because you need to create your own models, because the standard models aren't sufficient. There aren't sufficient data points on some of the things that I look at. Mm-hmm. So if you download a spreadsheet from Bloomberg, it'll give you the basics. You can work out the inventory turn, but I don't even think I've forgotten whether it does or not, whether Bloomberg gives you the raw materials, work in progress, finished products distribution. And that you need that, that's like fundamental. And, that's a simple example, but there's all sorts of much more complicated examples. And, when we cover working capital in the forensic accounting course, we go much, much beyond basic in scissor days, because all sorts of tweaks and refinements you can do, which aren't simple, and each company is different.
Right, got it. Well, Steve, thank you so much for being on the podcast. It was awesome having you. Learned a lot. I believe our listeners will learn a lot as well. So thank you so much for being on. It's awesome having you.
Well, listen, thank you very much for having me. If people want to find me, I'm on Twitter at Steve Clapham. My website is behindthebalancesheet.com, and you can find me in all the other social media. The YouTube channel is worth checking out. And if your listeners want to sign up on my website, we've got a great members only club where I post various blogs and things, and there's a whole bunch of free training on there as well. Thank you.